Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The major recent feature here on this daily chart still is the gapping changeover action in mid-May, though there seems now to be some developments in that area which I will discuss shortly. What that gap did was accelerate a move down, one that had been codified by the weekly key reversal down made in the second week of May. The changeover gap action took out the previously highlighted congestion at 1378, a congestion that had been evident late last year as well as March this year. This is now resistance. This move down also highlighted the March to date action as being a bearish halfway hesitation. Interestingly, the gap lower punch right down through the potential target for this bearish pattern in the 1350 area. Then 3 weeks ago, prices made a momentous move, not the obvious one of punching and closing below the middle time of the acute March to April bearish Andrews pitchfork, currently 1231, which is highlighted in dark blue on my daily chart. Don't get me wrong, that was a significant move, but it was the move down below the 1300 level to which I'm referring to. You see, beans were no longer in the teens. At the same time, we saw prices punch down through and close below the 50% Fibonacci line of the April 20 to February 22 move at 1289, as if it wasn't even there. This had been the first support of note below the middle time. Further falls came with the market taking out the 50% Fibonacci line of the May 2019 to February 22 move at 1275, halting briefly ahead of the late last year congestion support at 1243. Then 2 weeks ago, prices punched down through and closed below the December 2021 low at 1223, trying even lower towards a combination of descending lower time, currently 1137, and the 2021 lower at 1181. However, that week was when the decline all stopped, with a 3-day bullish morning doji star pattern, something I'd highlighted last week. Now, 12 weeks ago, I gave the following comments when looking at the longer term charts, and I quote, "The possibility that we now had a February 2021 to date bear flag. This has set up the opportunity. It would very much depend on two factors. Will the market hold the congestion at 1378 that had formed the lower trend line of the descending triangle from late last year? And if not, will it halt at the July 2022 low at 1304? If the answer is no to both, then we may well have a bear flag formation with potential down as far as the 1120 zone. Quite a big move if it does come about," end of quote. Now, the market's come a long way towards seeing that second potential down in the 1120 zone. However, there is one other point I'd like to raise, and it's something I've spoken about now for a few weeks. On the longer term charts, I verbally highlighted the 5-year moving average, currently 1181. This ultra long-term moving average, along with at the time the descending lower time, plus the 2021 low, was the reason we were seeing for the first time since mid-May some hesitation and a possible aversion from going lower. I said last week it was worth keeping a close eye on these three, and so it has turned out. You see, last Thursday, the market eventually, after 3 previous sessions of indecisive spinning tops, eventually made a combined key reversal up and bullish engulfing pattern. This led to this past Tuesday's attempt at breaching the upper time, currently at 1326 of the key bearish Andrews pitchfork, and by extension today's breach of the upper time. Thus, we have two things to recognize here in this market. Firstly, even though it's a big one, this is still just a breach, a good-looking breach of the bearish pitchfork. Unless the market can repair itself, and by that I mean really soon, then I will unhighlight this pitchfork with you to possibly retiring it. Second, last Tuesday's actions psychologically may have had a big impact because beans are once again in the teens. So the next area to look at now is the top side of the gap, and just below it the 1378 congestion. Chicago soybean meal. Once again, I feel obliged to start this commentary noting the monthly key reversal down here in March. This has been the key and the start of what has been the most recent move lower. The bigger picture here, well, that has for months and months now had different patterns crashing in and out of each other. The bigger picture here, the biggest pattern here, has been the May to date broken, then repaired, then broken again, ascending, expanding wedge pattern. A huge pattern that I pointed out many months ago, and ever since, It was never a perfect pattern by any means, but it finally started working in late May. To assist in seeing this pattern, I've highlighted it here on my daily chart in dark blue. However, the upper trend line is slowly exiting top left on my daily chart. Now, it is worth noting that the lower trend line of this pattern is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern, currently 425.40. The break lower in May below this trend line and neckline combination indicates a potential primary target that is still well off the bottom of my daily chart at the incredible 324 zone, and a secondary harder to reach, much harder to reach target in a 283 zone. These are the ones you can write in the back of your diary and maybe look at once or twice a year. There is, however, a nearer, more immediate pattern or patterns to look at. To start with, we had a bearish halfway hesitation formed over mid-April to late May. This had a target in the 390 zone, which was achieved 2 weeks ago. This move lower punched down through some significant supports, consisting of the 50% Fibonacci line, the August 20 to March 22 move, at 390 even, and the 2022 low at 386.30. However, the market formed a 3-day bullish morning star pattern and pushed up over both with penetrations below but no closes through either supports, no closes under either supports. Thus, the market sat on the base of the 50% Fibonacci line for 2 weeks until yesterday, when it finally gave way. We had the first close below both the 50% Fibonacci line and the 2022 low. So that's where we are. What does it show for the future? Well, there are 2 ways to look at this. The first is to look at the action since mid-May as a potential for a small bearish halfway hesitation, much as the one we had seen between mid-April and the end of May. The second way is to look at the action since mid-May as a possible double bottom in formation. This would rely on the 2022 low and the low of May, plus the lesser Fibonacci support of 381.40, all holding up the market. I'm agnostic on either one, but I would observe the longer we stay around these levels, the more opportunity there may be for a further move lower. This brings me to my final point, which I raised 2 weeks ago. On my long-term monthly charts, with less than half the year gone, 2023 is set to possibly already be an annual key reversal. Thus, if we were to close on New Year's Eve 2023 either above 471 even or under 399.10, then we'd be on. Anything in between would have a lesser outside year. Right now we are looking at a possible annual key reversal down, but we still have so many months to go. Chicago soybean oil. The key pattern here, which I highlighted some time ago, is the late November 2022 to date descending wedge pattern. This is easily seen as highlighted in purple on my daily chart. That's currently 49.11 to 45.25. This pattern ties in with my comments from 10 weeks ago when I looked at the longer term picture, and I said at the time, and I quote, "Looking at longer term chart and we can see a topping action in formation. Though whether it's a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until a 50% absolute Fibonacci line at 43.82, end of quote. Thus, it seemed then, and for quite a while after, that we were in a bearish trajectory, moving down more or less within this late November 22 to date descending wedge pattern. Now, it's not a perfect pattern. Well, you could hardly expect it to be after over 6 months of continuously watching the market try and thread in between the trend lines and them narrowing all the time. And that was until last week when the market broke higher out of the pattern, initially with a daily key reversal up, and finishing last week over the flatlining short medium moving average, well clear of the upper trend line, over the May 2013 high at 51.26 and just under the February 2013 high at 54.15. With this move, I consider it more than a breach and indeed a break higher out of the top of the descending wedge pattern. This week, prices have yesterday and today punched up over the February 2013 high and slowly declining medium moving average, currently 55.18, and today tested, maybe already finished testing, the 50% Fibonacci line of the March 2020 to April 22 move at 56.34. Now, before I outline some topside targets for such patterns, I thought it best to outline what is up ahead. We have 2 areas of congestion. The first is between 57.64 to 59.44. This is a wide but seemingly interesting band, which has the old August 2011 high within it. The second is smaller, between 61 even to 61.11, which has the 2011 high at 61 even as part of it. However, a more interesting interpretation of this is that just underneath this small band is the almost flatlining long moving average, currently 60.81, which is an important reinforcement of this small congestion. Okay, let's now look at potential topside for this broken descending wedge pattern. Okay, so a primary target X would be in the 67.5 area for such a pattern. The secondary harder to reach target X1 for such a pattern in the 78.20 area.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.